Hello, dear subscribers and viewers. Thank you for tuning in. Today, we're diving into a topic that's crucial for everyone, regardless of where you stand on the investing spectrum. Yes, we're talking about risk management in investing. This concept is the beating heart of any successful investment strategy. Whether you're just starting out, dipping your toes into the world of stocks, bonds, and mutual funds, or whether you are a seasoned investor with a diverse portfolio, understanding risk management can make all the difference. It's more than just a set of rules or a safety net. It's about making informed decisions, about balancing the scales of potential profit and possible loss. It's about being in the driver's seat of your financial future. So buckle up for an enlightening journey into the world of risk management. First, let's clarify what risk management in investing is. Picture yourself walking on a tightrope. The tightrope is your investment journey, and the ground below represents the potential financial losses you could endure. Now, imagine you're equipped with a safety net and a balance bar. These tools represent risk management. Their purpose is to mitigate the potential fall, or even prevent it from happening in the first place. At its core, risk management is a strategic process. It's about identifying, evaluating, and prioritizing potential financial risks. Let's break that down a bit. Firstly, identifying risks. This is all about understanding what could go wrong in your investment journey. It might be market volatility, changes in interest rates, or perhaps geopolitical factors. It's about being aware of the potential pitfalls that could impact your financial goals. Secondly, evaluating risks. This stage involves assessing the potential impact of each identified risk. Not all risks are created equal, after all. Some might cause a minor stumble on your investment journey, while others could lead to a significant fall. The key here is understanding the severity of each risk and how likely it is to occur. Lastly, prioritizing risks. Once you've identified and evaluated the potential risks, you need to decide which ones require your immediate attention and which ones can be monitored over time. This is where you weigh the potential harm against the cost of mitigating the risk. It's a delicate balance between risk and reward. But remember, risk management isn't about avoiding risk altogether. That's nearly impossible in the world of investing. Instead, it's about making calculated decisions, leveraging tools and strategies to lessen the potential negative impact of those risks on your investments. In essence, risk management is all about making informed decisions to secure your investments. It's the safety net that catches you when you stumble, and the balance bar that keeps you steady on your investment journey. Now that we've defined risk management, let's delve into why it's so important. Risk management is the life jacket in the ocean of investments. It's the protective shield that helps in safeguarding our hard-earned money from the unpredictable tides of the market. It's not just about avoiding risks, but more about understanding them, controlling them, and turning them into opportunities. Imagine you're stepping into a forest full of unknown creatures and paths. Would you go in unprepared? Of course not. So why would we dive into the investment world without a plan? Risk management is that plan, that preparation. It's the map that guides us through the forest of investments, helping us to avoid the dangerous beasts of loss and leading us towards the treasures of returns. When we talk about financial security, we're essentially talking about risk management. It's the tool that helps us in maintaining a balance between risk and reward. It's like the fulcrum of a seesaw, keeping our investments from tipping too far in either direction. By recognizing the potential risks and taking appropriate steps to mitigate them, we ensure that our financial future remains secure and prosperous. But risk management isn't just about playing defense. It's also about maximizing returns. It's about making calculated decisions that can lead to bigger rewards. It's like a game of chess where every move is made after assessing the risks and rewards. The right risk management strategy can help us make those winning moves. Moreover, risk management helps us in making informed decisions. It equips us with the knowledge to differentiate between a good risk and a bad one. It's like having a secret decoder ring that helps us decipher the complex language of investments. In essence, risk management is the cornerstone of successful investing. It's the compass that guides us in the right direction, the shield that protects us from financial harm, and the tool that equips us to seize the opportunities that come our way. Without risk management, investing would be like navigating a ship without a compass. Risk management isn't a one-size-fits-all process. It involves several key components. Firstly, we have risk identification. This is where we pinpoint potential threats that could derail our investment goals. Think of it as a reconnaissance mission, where we're scouting the landscape for any possible pitfalls or obstacles that could emerge down the line. This could include anything from market volatility to changes in economic policy to shifts in consumer behavior. Next, we have risk assessment. This is where we calculate the impact and likelihood of each identified risk. It's a bit like a weather forecast, where we are trying to predict the severity of the storm and how likely it is to hit us. We might use statistical analysis, scenario planning, or even just good old-fashioned expert judgment to make these assessments. Then comes risk control. This is where we decide on the most appropriate action to take for each risk based on our assessment. We might choose to avoid the risk altogether, accept it, or seek ways to mitigate its impact. In essence, we're plotting our course and deciding which risks are worth taking and which ones are not. It's a delicate balancing act between risk and reward. Finally, we have risk monitoring. This is where we keep a close eye on our portfolio and the wider market, watching for signs of the risks we've identified. It's a bit like a watchtower, where we're constantly scanning the horizon for any changes that could affect our investment. If a risk starts to materialize, we might need to adjust our strategy accordingly. But remember, these components aren't standalone activities. They're part of a continuous cycle, where we're constantly identifying, assessing, controlling, and monitoring risks. It's a dynamic process that requires vigilance, flexibility, and adaptability. Each component plays a crucial role in creating a comprehensive risk management strategy. Weaving them together, we build a robust shield that protects our investments from the unforeseen, allowing us to navigate the choppy waters of the investment world with confidence and poise. To wrap things up, here are some tips to help you manage risk effectively. First and foremost, diversifying your investments is a crucial step in risk management. Think of it as not putting all your eggs in one basket. By spreading your investments across a variety of asset classes, sectors, and geographic regions, you can reduce the potential for massive losses. Remember, when one sector struggles, another may thrive. It's all about balance. Staying informed about market trends is another key element. The financial market is dynamic and changes rapidly. Understanding these changes as they occur can help you make informed decisions about your investments. This doesn't mean you need to become a financial expert or spend every waking hour glued to financial news. Instead, set aside regular time to review market trends and consider how they might affect your investment strategy. Now, let's talk about adjusting your investment strategies. As your life changes, so too will your financial goals and risk tolerance. Perhaps you're nearing retirement, or you've just welcomed a new addition to your family. These life milestones can significantly impact your financial strategy. Regularly reviewing and adjusting your investment strategy will ensure it continues to align with your current situation and long-term goals. Another tip is to avoid emotional investing. It's easy to let fear or greed drive your decisions, especially during periods of market volatility. However, emotional investing can lead to poor choices and increased risk. Always strive to make rational, informed decisions based on your investment plan and not on your emotions. Lastly, consider seeking professional advice. Financial advisors can provide valuable insight and guidance, helping you to navigate the complexities of risk management. They can assist in creating a personalized investment strategy that aligns with your risk tolerance and financial goals. Remember, Effective risk management is a continuous process, not a one-time task. It's about constantly reassessing your situation, staying informed, and making adjustments as necessary. By following these tips, you're not just managing risk, you're positioning yourself for a more secure financial future. And that's a wrap on our introduction to risk management in investing. We've traversed the landscape of risk management, defining its integral role in the sphere of investing. We've underscored its significance, reminding ourselves that the ability to manage risk effectively is not just a bonus, but a necessity in the unpredictable world of investments. We've delved into the key components of risk management, from understanding the types of risk to measuring and mitigating them. We've also shared valuable tips on how to manage risk effectively, emphasizing the need for continuous education, diversification, and regular portfolio reviews. Remember, the world of investing is filled with opportunities, but it also comes with its fair share of risks. Navigating this terrain requires a well-equipped toolkit, and risk management is an essential tool in that box. Don't forget to subscribe to our channel for more insightful content. Until next time, stay smart and invest wisely.